Welcome to our video about international taxation. Zugimpex understands that customers want to act legally, but also minimize their tax burden. Many advisors ask clients about their plans and then tell them what is not possible. Zugimpex asks clients for their goals and helps to find ways to make it possible. For a good start, you need some basic knowledge about the relevant elements for international tax planning. Exactly this you find here in our video. Please press full screen so you can better read the information provided in this video. Why do successful businesses engage in tax planning? It is human nature to look for benefits. Children, for example, know what is forbidden by the mother and allowed by the father. They go to the grandmother for additional pocket money, and they ask the worker on the street to buy them a beer in the shop.
Businesses look which countries offer good business conditions, they transfer functions and use advantages from tax treaties. They check alternatives if there are too many regulations and taxes, and they invest where the authorities are business-friendly.
If country A offers many benefits but charges high taxes and country B offers little benefits for less tax, it makes sense to receive benefits in country A and to pay tax in country B.
However, high taxes do not automatically mean high benefits. Many nations need money to service debts, and other countries pay large parts of the budgets for social transfers to people who are able but not willing to work, while the economy must employ migrants to meet the demand. Now let us look at cross-border activities in an international context.
Regarding tax laws, there is a hierarchy. The starting point is national tax law that also considers taxation of international activities. Then there are the Double Tax Treaties. They are bilateral agreements that allocate and limit the taxing rights of the contracting states. Almost all double tax treaties can be found on the internet, but we have to check carefully if they are applicable. In addition, there are multilateral agreements that usually cover a few topics for a group of participating countries.
Basically, national tax law always applies. The conventions have their proper definitions and allocate the right to tax to a contracting state. Therefore, we must know the local legislations, but we can benefit from differences. There are cases where a specific situation qualifies differently in the legislation of two countries, and this can even lead to double non-taxation. Who knows?
Zugimpex. Now let us look at the double tax treaties. Almost all of them follow one of the versions of the OECD Model Tax Convention. Here is the basic structure. The first articles cover definitions. Important is Article 4 about residence and Article 5 about permanent establishment. The following Articles 6 to 21 mention different income categories and define which state has the right to tax, the source state or site state, the resident state, or both.
Article 22 deals with taxation of capital. Article 23 defines how double taxation is avoided. The credit method allows the resident state to tax the income if credit is given to the tax paid in the source state. The exemption method allows only the source state to tax the income, but the resident state can consider the exempted income when calculating the tax on the remaining income of the taxpayer. Now let us look at the different income categories.
Article 6 states that income from immovable property is taxed where the property is located. Article 7 says that business income shall be taxed only in the source state. Similar, Article 8 defines that profits from ships or aircraft shall be taxed where the effective management is situated. Article 9 clarifies the right for countries to modify transfer prices between associated enterprises if prices or conditions differ from those which would be agreed between independent parties.
Articles 10 to 13 deal with passive income and capital gains. Dividends, interests, royalties, and capital gains from movable property are taxed in the resident state, but often the source country has limited rights to tax too. Capital gains from immovable property are taxed in the site state.
Please note that employment income and directors' fees are taxable in the source state in most cases. Here you see the remaining income categories on the screen. Article 23, we showed it already, shows if the exemption method or the credit method is applicable.
To summarize, Active income usually is taxable in the source state, while income from short-time employment and passive income is taxed by the resident state, but there might be a withholding tax in the source state too.
And finally, as we mentioned in the overview, there are the multilateral agreements that can be applicable. Usually, the contracting states have implemented them already in their national legislation. Examples in the EU are the Parent Subsidiary Directive of the EU.
For dividends between EU-associated companies, there shall be no withholding tax at the subsidiary and no tax at the parent company. A similar rule applies for capital gains.
Merger Directive. Cross-border mergers, splits and acquisitions shall be tax-free within the EU. Interest and Royalties Directive. Here shall be no withholding tax for transactions between associated companies in the EU. And this brings us to the topic of tax planning. Tax planning should not only include tax rates, but maximize total net income. Like the concept of total costs of ownership in IT, we recommend an integrated approach that considers factors like setup costs, structure costs, cost differences for new processes and regulations.
Often, a setup requires a change in business processes. Therefore, we start with the definition of existing business processes and current taxation. Who pays tax? What is the tax base and how is the tax calculated? In the next step, we look at possible criteria outside the topic of taxation and decide which of them are relevant for the specific business case. Low setup costs and low structure costs. Low bureaucratic requirements, liberal business environment. Accessibility, time zone and logistics. Possibilities to get a bank account, which can be in another country. Other criteria are no requirements for audits. Implication on credibility, marketing and sales. Low labor costs and sufficient availability of qualified personnel. Asset protection and transparency. Service-oriented, accessible tax authorities with little arbitrariness. Then we can make a short list of possible countries.
Now we can get information about the possibilities to reduce taxes and social charges. On business profits, employment income and self-employment income. On passive income from dividends, interest, royalties and capital gains. Regarding VAT, inheritance tax, real estate tax and other tax categories. Finally, when a decision is made, there must be a plan for a proper implementation. This includes the planning of the transfer and the planning of real new processes with substance, website, stationery, stamp, contracts, documentation, invoices, financial planning and transfer prices.
With proper implementation, companies enjoy lower tax, lower costs, rapid growth and higher profit.
Thank you for watching this video. If you did it because you want to act legally, but increase profits and save tax, do not wait, but contact us on our website, www.zugimpex.com.